The session today, pretty low volumes, and it felt like investors were hugging the sidelines today.
Kate, we were seeing some low volumes going through today, and it was a disappointing day on the market. We did close down around 0.3% in the end. Having a look at some of those sectors, firstly, that industrial sector really was the worst performer for most of the day, and it did close down around 1.4%. That was, in fact, being dragged lower by Downer EDI after it did come through with their announcement that their mine over in Queensland was being terminated, and that stock, in fact, closed down around 11%. And was the worst performer on the ASX 200 today. We did also see that materials space in focus. It closed down around 0.7%. We did see iron ore prices coming off overnight, and as a result we saw a lot of those iron ore miners coming under pressure and really dragging down that materials space. So Fortescue was down around 2%, Atlas Iron down around 3.8%, and BC Iron down 3.6%. We did see some gains in some of those gold stocks, however, after we did see gold up overnight, but overall we couldn't hold up some of those gains in that materials space. The energy space was also lower by about 0.5%, and of course that consumer discretionary area down around 0.6%. We did see the likes of Super Retail Group as well as Premier Investments leading those falls in that segment, but we also did see Pacific Brands as well as the Reject Shop gaining strongly today after we did see those earnings downgrades coming through yesterday. But overall a fairly disappointing day on the market today.
Did you see any further pain there?
I certainly think the coal industry is coming under pressure, Kate. We are starting to see Australia facing a sharp decline in mining investment, as we know, as a result of surging supply and, of course, China's decline in growth and demand, which is obviously putting a lot of downward pressure not only on that iron ore price but as well coal prices. So we have been seeing that iron ore price coming under pressure, which obviously is affecting a lot of those iron ore producers, but of course that hard coking coal price is also coming under pressure, and it's slumped in fact by about half since the start of 2012, down to around $110 a tonne, which in fact is the lowest it's reached in around 7 years. We are in fact estimating that we will start to see a slight pickup in some of those coal prices. So coming into December 2014, we're estimating that will pick up to around $143 a tonne, and in December 2015 expecting that to pick up to around $158 a tonne. But overall the coal industry really is undergoing a difficult time, and to be globally competitive, a lot of these coal producers are having to adjust their cost bases. So not only really is it a risk for a lot of these coal producers, but it's also a risk for those mining services companies, and we have seen that with the likes of Downer EDI today, but also the likes of Monadelphous, Worley Parsons, Bradken, all potentially could be coming under pressure. Having a look at a slight positive, however, out of all of this, the weak coal prices that we are seeing have created a potential opportunity for a lot of those junior coal miners to consolidate and for those larger players to acquire some of those undervalued assets. And we have been seeing that recently with Aquila Resources after it received a takeover bid from China's Bayo Steel and Horizon. But of course we are seeing some further play in that space today as well. But overall are seeing a bit of pressure in this coal industry.
Investors were expecting something worse, perhaps an actual downgrade rather than a narrowing to the lower side.
That's exactly right, Kate. I think initially this morning investors hadn't quite digested the detail of the announcement, and that's why we did see the stock falling off. But once investors did realise that in fact this was just an earnings downgrade to their guidance, so guiding to the lower to midpoint of their already guided range to the market, I do in fact think investors realised that, and we did see the stock turn around, and as a result, as you say, we did close up around 1.15%. We do in fact remain fairly positive on the outlook for Flight Centre despite receiving this downgrade today. We do consider it to be a company that is a leader in its segment, generating strong free cash flow capability as well as an attractive return on equity of around 27% in 2014 and about 28% in 2015. We do remain confident that their domestic leisure business will continue to perform strongly. However, there are still a couple of downside risks with the company we do need to consider. So continued growth in that online flights segment could potentially have an impact on Flight Centre's earnings, given that they have a limited presence in that online area. Not only that, continuing to see deteriorating economic conditions could have an impact, and of course any currency fluctuations. So we know that Flight Centre generates around 45% of its revenues outside of Australia. So there are a couple of risks there to still consider, but overall we do remain positive on the outlook, and of course it wasn't such bad news that came through today. We are forecasting earnings per share growth of around 13% in 2014 and about 14% in 2015.